Regulatory control on Treasury. Intermediation process. The role of intermediation in the financial sector is performed by most banks. Thus, it is clear that the banks deploy deposits and various other liabilities of different maturities, sizes, and prices. Facilitated by the status and confidence of depositors, banks always enjoy the best managerial discretion of managing financial risks, notably the credit risk. However, there is always a time lag that is created in the process of intermediation between creation of assets and acceptance of liabilities which match with the assets. So also banks may have done with investments that are medium term or short term investments, but may not have matching resources for raising funds. Also, there may exist conditions where depositors withdraw their deposits prematurely and borrowers quickly repay their loans. All these conditions may lead to situations where the banks may be facing a liquidity surplus or a surplus fund, and at other times facing funds crunch or a liquidity deficit. When that happens, banks try to park the surplus funds in first short-term and earning assets and then try to invest in more stable assets, whereas deficit is dealt with by borrowing short-term before making sure a stable resource is tied up for the long term. On the other hand, the liquidity available in the system may be one of 1. Balances with RBI in excess of statutory reserves required to be maintained by the bank. 2. Money market. And 3. Balances maintained by financial institutions with the Reserve Bank. Money market. Money market provides the missing link between users of liquidity and providers of liquidity and acts as a medium for balancing liquidity surplus and liquidity deficit in the short term. Money market is the place where monetary policy signals of the central or reserve bank are aimed for controlling short-term liquidity in the system. Money market should have systems in place ensuring limitation of counterparty risk to protect its participants. Money market in that sense should also be very liquid, considering short-term liquidities are traded in heavy volume. In the absence of a proper regulatory mechanism by the Reserve Bank, money market problems can escalate into risky situations and incidents and may result in huge losses to its participants. The money market used to be functioning just like a telephone market. The Reserve Bank has made it clear its guidance to make call money market a pure interbank market with primary dealers and banks as its members. The lending by non-banks is the call money market is currently not there in service or is facing extinction in the new order. Under Section 16 of the Securities Contracts or Regulations Act 1956, the Reserve Bank regulates the money market and all its instruments where the government has delegated power to the Reserve Bank for regulating contracts in gold-related securities, derivatives based on securities, forward contracts in debt securities, government securities, as well as money market securities. Money market has also undergone vast changes of progress throughout its existence in India. This is evident in the introduction of negotiated dealing systems, real-time gross settlement system or RTGS, and Clearing Corporation of India, where the payment and settlement infrastructure is competing with international standards, facilitating price discovery and better turnover by addressing systemic risk. It is hoped that future money market will be totally a screen and systems driven system. Self-regulation. FEDI or Foreign Exchange Dealers Association is the self-regulating authority or SRO in the Indian foreign exchange market. For money market, the SRO is FIMMDA or Fixed Income Money Market and Derivatives Association. For promoting their use in money markets, FIMMDA has developed standard master agreements for various types of money market transactions. It has also taken resourcefulness to frame a code of conduct that makes sure adherence to the code is followed by the market participants. Regulatory control by the Reserve Bank on the Treasury. Reserve Bank of India controls market liquidity and fulfills its role in the payment and settlement systems as well as in the role of a lenders of last choice. The Treasury's foremost responsibility is to fulfill the CRR and SLR requirement as it is stipulated by the Reserve Bank. Treasury should submit Form A with information on CRR and SLR on a strict fortnightly basis. Any default in reporting or an impending deficit in these requirements can invite a penalty from the Reserve Bank or may seriously damage the bank's reputation. DTL, Demand Time Liability. Demand time liabilities of a bank include demand liabilities, time liabilities, and other demand time liabilities. Demand liabilities include balances in FD which are overdue. Demand liabilities, current deposits, outstanding TT, MT, DDs, cash certificates and recurring deposits, unclaimed deposits, credit balances in current CC accounts, and deposits for advances held as securities which are payable on demand. Time liabilities of a bank include fixed deposits, cash certificates, cumulative and recurring deposits, time liabilities portion of savings bank deposits, staff security deposits, margins, etc. Other DTL includes interest accrued on deposits, unpaid dividends, bill payable, etc. CRR and SLR, cash reserve and statutory reserve requirements of Reserve Bank. CRR, liquidity refers to the excess cash that a bank has, which is called also known as capital, which indicates money supply that has not been absorbed by the current economy. Whereas a shortfall in liquidity may result in depreciation of exchange rate or higher interest rate, an excess of liquidity may immediately lead to inflation. Reserve Bank of India is often called to control the amount of liquidity so that movement of interest rate and exchange rate remains consistent with the projected growth rate of the economy. CRR and SLR are the two important instruments in the hand of RBI which is used to control money supply, which is again indicated by M3 and is the supply of money where cash or currency make up only 25% of the money supply indicated by M1. Multiplier effect is M3 divided by M1 and is called money multiplier effect. It is also understood that money multiplier effect reduces the importance of cash in circulation, thereby making the replenishing function of RBI, replenishing physical stock of currency notes, a mere utility function than a control function. Reserve money is the money impounded by Reserve Bank by means of cash reserve ratio whose intention is to reduce the money multiplier effect. It also allows the Reserve Bank to control liquidity in the system by providing a cushion of money to the banks whenever it is needed from the reserve ratios. That is because reserve assets refer to the cash deposited by the scheduled commercial bank to comply with the cash reserve ratio requirement of the Reserve Bank. According to the RBI Act of 2006 and its amendment in 2007, CRR is prescribed as 3% and 20% of demand time liabilities of the bank according to the RBI Act of 1934. SLR, cash deposited by scheduled commercial bank in the form of funds invested in government securities and other approved securities should be in compliance to the statutory liquidity ratio requirement by the Reserve Bank. According to an amendment of the Reserve Bank Act in 2006, the minimum and maximum SLR was prescribed at 25% and 40% of DTL respectively. The SLR is to be maintained in the form of assets mentioned below and are gold, that is valued at a price not exceeding price in current market, approved securities valued as per RBI norms, and cash balances excluding balances maintained for CRR. RBI from time to time may change the components of DRL for SLR CRR calculations and also the type of securities included in the categories as mentioned. Net liabilities of interbank liabilities are removed from this calculation or for the purpose of section 42 is excluded, and scheduled banks' net liability to the entire banking system is considered liabilities of the system. Penalties for shortfall in CRR and SLR to the bank. The formal penalties to the bank for a deficiency in statutory requirements are: 1. Bank pays 3% interest rate on the shortfall amount, and 2. Bank pays 3% plus additional 2% from second fortnight on the shortfall amount. Generally, the Reserve Bank takes a very serious view on the bank's failure to maintain the statutory requirements as well as the reserve ratios.